If you bought a home in Metro Vancouver in the past 5 years, there's a real chance you're living inside a financial decision that once made sense on paper, but doesn't anymore. Mortgage renewals are coming in at hundreds of dollars more per month. Pre-sale appraisals are coming in tens of thousands of dollars short. Families who bought townhomes are stuck in homes their lives have already outgrown. And most of these buyers had no idea any of this was coming. Today, I'm breaking down the 5 biggest reasons Vancouver and Fraser Valley buyers are feeling regret about their purchase in 2026 and what to look for so you don't end up in the same position. Reason number 1, they only ran the mortgage numbers, not the Lower Mainland stack. So most buyers I sit down with got approved by a lender, the math on the calculator worked, and they went for it. The problem is the number the lender used isn't the number you live with every month after closing. The real cost of owning a home here stacks up pretty fast because you've got your mortgage, property taxes, strata fees, insurance, utilities, basic upkeep, and the one that surprises everybody, the special levies. And for anyone watching from outside BC, here a strata is what we call an HOA or a condo association. So the strata side is where buyer's costs can really add up. For condos and townhomes here in Surrey or Langley, you're looking at somewhere between $250 to $400 a month just for strata fees. Add in a few amenities like pools, large fitness centers, and they can easily go over $500 a month. And in a bit, I'll talk about pre-sales because that's where this kind of financial squeeze can really hit home. But let's stick to the hidden costs for now. So what's a special levy? It's a one-time charge when strata doesn't have enough money saved up to cover a big repair. Think of a new roof, building envelope, elevator, plumbing. These can run anywhere from a few thousand to tens of thousands of dollars per unit, and they sometimes show up with very little warning. That being said, the part that should worry you is the funding side. A report came out earlier this year showing that more than 3/4 of BC strata corporations are poorly funded, while over half are sitting in critical territory. That's the part nobody budgets for at the kitchen table when they're deciding to buy. So the fix here is simple. Before you buy, figure out the total of all the monthly costs of owning. If you're looking at a condo or townhome, ask for the depreciation report and the last 2 years of strata minutes. That'll tell you a lot about what's coming. But you can do all the budgeting in the world and still end up regretting your purchase if you skip the next thing that's on the list. Before we go further, if you're watching from outside BC and you're thinking about making a move to Surrey, Langley, or White Rock, I deal with this all the time. So grab our full relocation guide and reach out anytime. Both these links are down in the description. All right, let's get back to it. Reason number 2, they picked the property before they tested the lifestyle. So a lot of buyers in 2021 and 2022 picked a home the way you'd pick a vacation rental. They saw the photos, they liked the kitchen, the price per square foot looked good compared to Vancouver, and they signed without a second thought. What they didn't do is test the lifestyle that came with that address, which is a huge mistake. That being said, the south of Fraser is composed of 3 pretty different neighborhoods. Surrey is fast growing with lots of construction, lots of energy, and depending on the pocket you're in, can be right next to the new SkyTrain that's coming. Langley has more space and more of that suburban family feel, but the commute into Vancouver is a bit of a beast. Now, White Rock is highly lifestyle driven. You've got the beach, the pier, restaurants, slower pace, and you're sure paying a premium for it. But the commute data is the part that surprises people. Driving from Surrey city center to downtown Vancouver in rush hour, that's around 45 minutes to an hour. From Langley, you're looking at 60 to 80 minutes. From White Rock, South Surrey, 60 to 90 minutes, and that's just one way. Now, that being said, there is one upside to being out here. Surrey gets less rain than Vancouver and the North Shore. North Vancouver averages around 100 inches of rain a year. South Surrey is closer to 45. So if you're moving from somewhere drier and the stories about all the Vancouver rain are freaking you out, just know that if you move somewhere farther away from the North Shore mountains, you're gonna get a lot less of it. Now, you'll still get rain, but it's not the same as living up against the mountains. The way to avoid this regret is to reverse engineer your life before you pick the property. Do the commute both ways on a weekday. Spend a morning at the coffee shop near the home you're thinking about. Walk the kids' school route. A nicer house can't fix a daily routine that doesn't work, and that's the kind of mistake buyers spend living years inside of. But even the buyers who picked the right area for them are getting caught by something else that's entirely different, and it's hitting their wallets right now. Reason number 3, they bought with 2021-2022 urgency and are now facing 5-year mortgage renewal shocks. So forget the headlines for a second. The most financially urgent thing happening in this market right now isn't prices, and it isn't inventory. It's a wave of mortgage renewals hitting homeowners who locked in their rate when things were cheap. In 2021, buyers were in high pressure environment because inventory was tight and there were multiple offers on absolutely everything. And the way you won was by waiving subjects. That meant skipping inspections, financing conditions, even the appraisal just to get the deal. People compromised on what they wanted just to get their foot in the door. Now, the market has flipped since then. Inventory in Metro Vancouver right now is the highest we've seen in over 10 years. And buyers today have time, they have options, and they have leverage. But the people who bought back then are locked into decisions they made when they had none of those things. A lot of those buyers locked in a 5-year fixed in 2021 at around 1.5% to 2%. Those rates were the lowest in Canadian history. About 60% of Canadian mortgage holders go for that 5-year fixed rate, so this is not a niche group. Those 5-year terms are coming up right now in 2025 and 2026. The renewal rate today is sitting around 4%, probably just a little bit more for that 5-year fixed. So that means you're going from 2% to 4%, which sounds like a small jump, but on a lower mainland mortgage, it's massive. According to recent renewal data, a typical Canadian renewing in 2026 is paying around $620 more per month. That's about $7,400 more per year. Think about what that money could turn into if it was in your pocket. And on a bigger Vancouver mortgage, say $800,000, the increase is well over $1,000 a month. That kind of pressure is showing up in the resale data too. Detached homes across the Fraser Valley are sitting roughly 20 to 22% below their peak in 2022, and homes that were bought near the top are often sitting on the market today at well below what they originally paid. So if you're a buyer in this market today, the lesson is pretty clear. Slow down and breathe. You have time to do an inspection, time to get your financing properly arranged, and you should be stress testing that payment at a higher rate than what's available today. As painful as those renewals are, there's a group of buyers in this market who take that situation in a heartbeat, because the next regret can wipe out your down payment before you even own the home. Reason number 4, pre-sales and pre-construction expectations fell flat. So this is the most painful regret of all the ones we're covering. Pre-sale and pre-construction was a strategy for a lot of buyers from 2019 to 2022, and the pitch was simple. Lock in today's price, build equity while you wait for the building to be finished, and ride the rising market. Some people were buying with a plan to assign the contract before completion and pocket the difference, and of course, others were buying to live in. But the reality has been brutal. Interest rates jumped, construction costs went up, and the most alarming part, appraisals are coming in lower than the original purchase price. So the Metro Vancouver condo benchmark is sitting in the low 700s right now, close to 6% down year over year. Some suburban projects are down 15 to 25% from their 22 pricing. Now, let me walk you through how the appraisal trap works. Say you signed a contract 3 years ago to buy a 2-bedroom Surrey condo for $700,000. The building's now finished and you're getting close to ready to close. The banker sends an appraiser and the appraiser says, well, today this unit is worth $640,000. The bank will only lend you 80% of the appraised value, not the contract price. So instead of needing $140,000 down, you suddenly need almost $200,000 down to close. That's an extra $48,000 in cash you may not have. And if you want to sign the contract to someone else, good luck. Nobody wants to take an assignment at the original 2022 price when they can see the completed unit is worth way less. On top of that, the BC government brought in a home flipping tax at the start of 2025. It applies to pre-sale assignments too, with a holding period that starts from when the original contract was signed, so a lot of flippers get squeezed from both sides. A lot of buyers are letting their deposits go and they're walking away because losing 50 grand on a deposit feels less painful than coming up with the cash to close on something that's already underwater. That being said, there's a layer underneath all of this that most buyers don't see. Developers are sitting on thousands of completed, unsold units across Metro Vancouver and the Fraser Valley. Late last year, that shadow inventory was estimated at around 3,000 units, and that puts downward pressure on every other pre-sale still working through completion. But buyers who skip pre-sale entirely and bought something real and finished are also running into a regret of their own, and it's the one that's freezing this whole market. Reason number 5, they bought peak-priced townhomes that don't fit their evolving lives. One of the other big reasons that this market is moving slowly now has almost nothing to do with rates, prices, or inventory, and everything to do with the number on a page that families can't stomach. It goes like this. A family bought a brand new townhome in Surrey, Langley, or Cloverdale somewhere in 2021, 2022. Let's say they paid close to $1 million, sometimes a bit more, sometimes a bit less, depending on the area. No big deal at the time. It made sense, sure. The townhome was new, it had 3 bedrooms, the kids were younger, the budget worked. 3 or 4 years later, their life has changed. Maybe they had another kid. Maybe the older ones need their own rooms. Maybe they want a yard, a workshop, a basement, a real backyard. So now they want to step up into a detached house. That's the natural progression most families make, and in a normal market, it works just fine. The problem is, the numbers don't work the way they used to. Fraser Valley Real Estate Board data shows the Surrey townhome benchmark peaked at around $890,000 in early 2022. Today, that benchmark is sitting closer to $790,000. That's an 11% drop from the peak. So that townhome bought at $1 million is probably worth somewhere in the low to mid 800s. And that's a loss of close to $200,000. But the detached home they want to move to has also come down. It's cheaper too. The math of the move works. The gap between the townhome sale and the detached purchase might even be smaller than it was at the peak. But on paper, taking a $200,000 loss feels brutal. And that's one of the psychological barriers that's freezing this market. People look at the number going backwards and they refuse to sell. They'd rather stay stuck in a home that doesn't fit their life than feel like they're locking in a loss. And that's the trap. You don't judge a move up by what your current home is worth versus what you paid. You judge it by the gap between your current home's value today and the price of the home you want today. If both have come down the same amount, the move can be more affordable than it actually was at the peak. So the way to think about this going forward, whether you're buying for the first time or upgrading, is in the 5 to 7 year horizon. Pick a home that can change with your life. The buyers carrying regret in 2026 are the ones who treated their purchase like a one-time decision instead of a 5 to 7 year bet. Today's market punishes urgency and rewards the people who slow down and ask better questions before they sign the contract. If you're feeling stuck on any one of these regrets, email me directly at info@moteam.ca and we'll walk through your situation together. And if you're trying to figure out which Surrey and Langley areas are safe to buy in right now, I've linked a video here that breaks down which neighborhoods are still in a seller's market. You've got to check it out before you make any moves. Thanks again for watching. We'll see you again in the next one.